This is part 2 of the series How Trading News Destroys Your Account, and today we'll be going over the delayed market movements during the high news events. So let's get started with analysis of the market moves on today's session. So we will be looking over London session and New York session. First of all, London session had nothing much, very low volatility, and most of you would have been executed a buy move because you would have seen a jump from this support level, creating a Asian liquidity, and then probably trying to execute the trade right over here after you have a break of the structure, and then trying to ride it at least 1 to 2, which would not have resulted you to any wins and actually would have stopped you out and resulted in a loss. So this would have been a loss number 1 on the trading day, which would have been an unnecessary loss for your trading account. Or some of you might have actually been maybe looking for the shorts right here with a stop loss right over here and actually being stopped out again due to spreads. Even for some reason you wouldn't have stopped out on the trading view, you would have had the spreads that would have stopped you out. And essentially you would also miss out, and then you would get irritated, frustrated on missing out so many moves, and essentially trying to take impulsive trading decisions, which would have resulted in unnecessary trading losses and maybe burnt out account or breach of your trading rules. Then let's look at the New York session when the actual testimony of the Fed chairman speech was coming out. So we can see as soon as we entered and he started talking, we did have a huge volatility. Maybe some of you were entering into short positions right over here. And I'm pretty sure most of you on TradingView, you would have seen that they're still in the trade, but essentially what this sort of moves create, they create an immense amount of spread. And this spread certainly 100% would have stopped you out. The spread during the Fed chairman speech is always very big and it will stop you out. And usually what happens, you will see candles not moving essentially, and then suddenly you see big swing up, big swing down, probably not getting entered, or you probably got liquidated instantly because of the high spreads and the moves were delayed. You would have seen a delayed movements in the market, and essentially you would also be like trading, oh, we had the, let's say, last liquidity sweep, break of structure from here, I'm going to be entering here, and what happens? Because you have news did not respect your level and actually stopped you out, and that's it, you get stopped out. And essentially due to the news, even you are bullish for euro and everything tells you to be bullish for euro, and that's what your overall higher time frame bias. On the lower time frames, market does not respect this. They don't care because Fed chairman is speaking, and whatever he's speaking bullishly for US dollar, and this created an actual manipulative move downside. And this actual manipulative move downside, what could have been from the higher time frame and feelings of some of the gaps that, or some of the levels that could create a potential move out later on. So probably this move might be moved to fill this gap, fair value gap right over here on this candle, or maybe something else, right? Maybe touch right over this imbalance. And you can see when there is a huge news impacts, you see a huge doji candles, you see gaps, you see imbalances, they create some sort of liquidity, they create some sort of imbalances and inefficiency in the market, or they sometimes are used to fill in some of the gaps. So you should avoid these trades. And what happens with delayed price movements is what you can see today. If you would have executed a trade right over here, you might not have gotten filled because the market would have such a big volume of trades incoming. Right, you can see from this wick candle that you would not have been executed. Your live trading account like MetaTrader would have frozen down, and then you would see suddenly a huge spike up and then suddenly huge spike down. And this is what's called the delayed market moves. And during these news events, no levels are usually respected. It's very low probability that any level would have been respected. You would have been stopped out here because you have an overall bullish bias, and then even if you had a bearish bias and somehow you executed right over here, you would have been stopped out due to spreads. And if you would have been executing right over here, being smart, assuming that this was a liquidity grab, you might have ended up profitable. But look at this, look at this. You might have been lucky and entered, but if you had a limit order placed, the spread still might have been high and you never would have gotten your entry. So this is very risky, this is unnecessary, and you should not be doing this. And if you would have followed route, you might assume most likely that this was a liquidity grab again. After this happened, you cleared this one out, and then you would be looking maybe for the buys, and then you would have stopped out. So As you can see, this is literally creating a gambling mindset. You are trying to speculate what might happen. You are not reacting usually on the trading days what is happening. What you're doing here right now is just trying to gamble. Your thinking is like, oh, okay, you have a 50-50 chance, like if this went down, probably I'm gonna enter not over here, but I'm gonna be entering right here to catch maybe continuation move down, and then suddenly you're placing your stop maybe somewhere here and then getting stopped out. Or you are somewhat smart and probably placing your limit enter here, and you're getting lucky to write down here. But essentially, if you look at your rules, you did have a liquidity site right over here. This one got cleared and you would be waiting for the break of the structure. I don't know if in lower time frame you would have seen a break of structure, you would have executed with a stop right over here, let's say, and you get stopped out right here. And then it's literally luck, nothing else right now. It's what you decide to do would be just a lucky move, and you just praying to get lucky. And this is not what trading is supposed to be. You're trading on the delayed moves, you're trading on the high spreads, and you're putting yourself in an insane amount of risks. If you are executing the trade and you're worrying, you are like shaking, going crazy, like, am I gonna win? Am I gonna lose? I don't know what's happening. You are not trading, you are gambling. You are not comfortable with the trade was bad, and you're not comfortable with taking this risk. So what you should do, you should avoid trading in that particular scenario and just relax. Let it be. You are not trading in that case. So my advice for you is to avoid trading during the news, especially when Fed Chairman Powell is speaking, because you have a delayed market moves, which means that price doesn't move essentially, and then it starts moving. So avoid this. Do not gamble. Be a disciplined trader, and by following the rules, you will pass your challenges, you will get funded and make money out of it. This is not about passing the challenge as soon as possible. This is about preserving your capital. You need only 5 winning trades with 1-to-2 risk reward ratio to pass the funded challenge, right? That's it. Just stay patient, stay calm, and look for the good opportunities, a high probability trades, not just random BS like these trades right here, right now during this sort of moves. So if you find this helpful, hit like and subscribe, and I will see you tomorrow on the part 3 where I'll be reviewing another Fed Chairman Powell speech.